The dollar funding crisis just went critical. And the funds are trapped. Dollar swap rates just spiked to 8%. Hong Kong overnight funding costs hit 13%. These are not normal market fluctuations. These are not the routine volatility that financial commentators dismiss with phrases like temporary technical pressure and short-term liquidity adjustments. These are the specific numbers that appear in the overnight funding markets immediately before systemic dollar funding crises that require Federal Reserve emergency intervention to prevent complete financial system seizure. The last time dollar swap rates moved with this velocity and this magnitude simultaneously across multiple financial centers was March 2020, when the Federal Reserve deployed $4 trillion in emergency asset purchases and activated swap lines with 14 central banks within 72 hours to prevent the global dollar funding system from collapsing under the weight of simultaneous dollar demand that the existing supply infrastructure could not satisfy. The response took 72 hours and $4 trillion. The current spike is larger in some metrics than the initial March 2020 move, and this time the Federal Reserve's balance sheet is already at $7.7 trillion. The ammunition that was used to stop the last crisis has not been fully replenished, and the crisis it is being asked to stop is bigger. Here is what dollar swap rates and Hong Kong overnight funding costs actually measure, and why these specific numbers at these specific levels represent the financial system's most urgent distress. Signal: dollar swap rates measure the cost of obtaining dollars by swapping another currency, typically euros, yen, or Hong Kong dollars into US dollars for a specific period through the foreign exchange derivatives market. When this cost is 8% annualized, it means that a European bank, an Asian asset manager, or a Hong Kong hedge fund that needs dollars for settlement, for margin calls, for collateral requirements, or for any of the dozens of operational dollar needs that the global financial system generates every day, is paying 8% above the risk-free rate to obtain those dollars through the swap market. 8% above the risk-free rate. In an environment where the risk-free rate is already 5.25%, meaning the effective cost of emergency dollar procurement through the swap market is over 13% annualized for some counterparties. This is not the cost of speculative dollar borrowing. This is the cost of operational dollar necessity, the cost of obtaining the currency that the global financial system requires to function at the most basic settlement and margin management level. When that cost reaches 13%, the financial institutions that need dollars operationally and cannot obtain them at prices their business models can absorb, begin failing to meet their obligations, not choosing to default, being forced to default by an arithmetic that leaves them no other option. The Hong Kong 13% overnight rate is the most alarming component of this event because Hong Kong is not a peripheral financial market. It is the gateway between the Western dollar financial system and the $18 trillion Chinese economy, the financial center through which dollar-denominated capital flows into and out of China, through which Hong Kong dollar-pegged defense operations are conducted, and through which the enormous volume of dollar-denominated trade finance that supports Chinese export manufacturing is originated and settled. When Hong Kong overnight funding costs hit 13%, the financial pipeline connecting the world's second-largest economy to the global dollar system is experiencing a pressure spike that the pipeline structural integrity was not designed to sustain indefinitely. And funds are trapped, not metaphorically trapped, operationally trapped. Asset managers, hedge funds and institutional investors with positions in Hong Kong dollar assets that they need to convert to dollars for redemptions, for margin calls elsewhere in their portfolios, for regulatory capital requirements, or for any of the operational dollar needs that their business models generate, are discovering that the dollar is available at 13%, and 13% changes the calculus of every position held, every redemption processed, and every margin call managed simultaneously. The trapped funds dynamic is the hidden financial nuke inside the dollar swap spike. When funds are trapped, when the cost of converting local currency positions to dollars exceeds the return on those positions, the rational institutional response is not to absorb the conversion cost. It is to liquidate the underlying positions rather than pay the conversion premium, sell the Hong Kong equities, sell the Asian bonds, sell the emerging market assets, generate the dollar proceeds directly from asset liquidation rather than paying 13% to swap local currency into dollars. This liquidation dynamic, simultaneous forced selling of Asian and emerging market assets by funds trapped by dollar funding costs, is what converts a dollar funding spike from a market stress event into a systemic contagion event. The asset sales depress prices. Depressed prices trigger more margin calls. More margin calls require more dollar procurement or more asset liquidation. More asset liquidation further depresses prices. The spiral tightens with mathematical inevitability until either the Federal Reserve provides the emergency dollar liquidity that breaks the spiral completes its destructive cycle through the financial system. The cross-currency basis swap, the specific instrument that dollar swap rates measure, is the global financial system's most sensitive real-time indicator of dollar scarcity stress. It represents the premium that non-dollar financial institutions pay to access the world's reserve currency through the derivatives market when normal interbank lending channels are insufficient to satisfy demand. A basis swap of negative 50 basis points, minus 0.5%, is elevated but manageable, representing mild dollar scarcity that the market can absorb without systemic stress. Negative 100 basis points, minus 1%, signals significant dollar shortage requiring monitoring. Negative 200 basis points, minus 2%, has historically triggered Federal Reserve swap line activation. The current spike represents basis swap levels that translate to effective dollar procurement costs that exceed every threshold the Federal Reserve has historically treated as requiring emergency intervention. And it is happening simultaneously in multiple financial centers, not contained to a single market that could be addressed through targeted intervention, but appearing across the interconnective, global dollar funding system in the specific pattern that precedes systemic cascade, rather than isolated stress. The specific mechanism generating the current dollar funding spike involves three converging forces that individually create elevated dollar demand and collectively create the acute shortage that 8% swap rates reflect. First, the commercial real estate refinancing wave, $1.5 trillion in maturing loans, is generating dollar demand from institutions that need to fund settlements, cover losses, and manage the cash flow consequences of a wave of loan workouts and distressed sales that all require dollar settlements simultaneously. Second, the margin call cascade from the geopolitical stress events in the Persian Gulf, the oil price spike, the equity market sell-off, the credit spread widening, is generating simultaneous dollar demand from leveraged funds whose positions across multiple asset classes are generating margin calls that must be met in dollars, regardless of the currency in which the underlying assets are denominated. Third, the seasonal quarter-end dollar demand, the standard period when financial institutions repatriate dollar earnings, adjust balance sheets for regulatory reporting, and manage the window dressing operations that make their quarter-end financial statements reflect the positions they want to show rather than the positions they actually hold, has compressed the normal timing of dollar demand into the same window as the stress-driven demand, creating a supply-demand imbalance that the normal market mechanisms cannot resolve at prices below crisis levels. The combination of these three forces, structural refinancing demand, margin call cascade, and seasonal concentration has produced a dollar shortage that the private market mechanisms for managing dollar scarcity have been unable to address at normal prices. And the Federal Reserve's response timeline, the speed with which it activates emergency swap lines, deploys repo facilities, or otherwise provides the emergency dollar liquidity that breaks the funding spiral, is the single most consequential variable determining whether the current spike is a severe but contained stress event or the trigger of a systemic contagion that transmits the dollar funding crisis from the overnight swap market to the broader financial system. The pattern of acute dollar funding crises, sudden severe spikes in the cost of dollar procurement through swap markets, generating forced asset liquidation, transmitting through the global financial system via the interconnected margin call and collateral management infrastructure, is one of the most precisely documented and least publicly understood phenomena in modern financial history. It has appeared with increasing frequency and increasing severity since the 2008 financial crisis, in 2011, during the European sovereign debt crisis, in 2015, during the China currency devaluation stress, in 2019 in the overnight repo market seizure, and most severely in March 2020. Each episode has required Federal Reserve intervention at greater scale than the previous one, and each episode has left the underlying vulnerabilities that generated it more concentrated, more interconnected, and more resistant to the non-emergency resolution that would prevent the next episode from being larger than the last. Study the 1931 international banking crisis with the specific analytical lens of dollar funding dynamics rather than the national banking system failures that dominate its historical account. The 1931 crisis began with the failure of the Austrian Creditanstalt Bank in May, a single institution whose failure triggered a chain of dollar funding demands across European banking systems that were interconnected through correspondent banking relationships, trade finance arrangements, and the gold standard's fixed exchange rate mechanism. European banks that needed dollars to meet their obligations to settle trade finance, to service dollar-denominated bonds, to maintain the gold convertibility commitments of their national currencies, found the dollar increasingly scarce and increasingly expensive, as every institution simultaneously attempted to obtain the same currency for the same operational necessity. The Bank of England attempted to manage the crisis with emergency lending. The Federal Reserve extended limited assistance. Neither institution provided dollar liquidity at the scale and speed that the interconnected demand required. The result was a cascade of banking system failures across Europe that produced the global banking crisis of 1931, the financial catastrophe that converted the 1929 stock market crash into the Great Depression by destroying the credit system that economic recovery required. The 1931 parallel is not exact. The Federal Reserve of 2025 has tools that the Federal Reserve of 1931 did not possess, the ability to create dollars without gold constraint, the institutional experience of managing dollar funding crises accumulated across multiple episodes since 2008, and the swap line network that allows it to provide dollar liquidity to foreign central banks without requiring those central banks to have dollar reserves of their own. But the 1931 parallel illuminates the specific mechanism that makes dollar funding crises systemically dangerous in ways that other financial stress events are not. The dollar is not just one currency among many. It is the settlement currency of the global financial system, the currency in which the vast majority of international trade, international debt, and international financial contracts are denominated and must ultimately be settled. When the supply of dollars for settlement purposes becomes acutely scarce, when the cost of obtaining settlement dollars reaches 13%, the global financial system's ability to function at its most basic operational level is compromised, not gradually, immediately. Settlement failures cascade, margin calls go unmet, credit lines are withdrawn, and the financial system that the dollar's settlement role was supposed to lubricate seizes up with the mechanical precision of a machine that has run out of the oil that prevents its moving parts from destroying each other through friction. The hidden financial force that makes the current dollar funding spike more dangerous than the historical precedents it resembles is the $313 trillion global debt structure that sits on top of the dollar settlement system and generates dollar demand at a scale that the Federal Reserve's emergency intervention machinery was not designed to satisfy at current debt levels. Every dollar of global debt that requires dollar settlement, every dollar-denominated bond coupon payment, every dollar-denominated trade finance settlement, every dollar-denominated derivative margin call, represents a unit of dollar demand that must be satisfied from the supply of dollars available in the global financial system. As global dollar debt has grown from $57 trillion in 2008 to its current level, the dollar demand generated by that debt's operational requirements has grown proportionally. The Federal Reserve's emergency intervention capacity has not grown proportionally. The gap between the dollar demand that the global debt structure generates during stress events and the dollar supply that emergency intervention can provide has been widening with every credit cycle. And the current spike is the most visible expression of that gap, reaching a level where the private market mechanisms that normally bridge it are insufficient, and the official mechanisms that backstop them are being asked to operate at a scale that their design parameters did not anticipate. Watch 5 developments in the next 48 to 72 hours that will determine whether the current dollar funding spike is contained through official intervention or escalates into the systemic contagion that 8% swap rates and 13% Hong Kong overnight costs imply as their natural trajectory. First, watch for Federal Reserve activation of its standing repo facility at volumes above $500 billion. The standing repo facility, the post-2019 permanent mechanism for providing dollar liquidity to primary dealers, has capacity that the Fed has been reluctant to deploy at maximum scale to avoid signaling the severity of the stress it is addressing. Deployment above $500 billion in a single day signals that the Fed has assessed the funding stress as systemic rather than technical. Second, watch for emergency Federal Reserve swap line activation with the European Central Bank, the Bank of Japan, and the Monetary Authority of Singapore simultaneously. The 2020 template involved coordinated swap line activation across 14 central banks within 72 hours. Coordinated activation of even 3 to 4 major central banks simultaneously signals that the dollar funding stress has transmitted beyond the capacity of any single central bank's domestic operations to address. Third, watch the Hong Kong Monetary Authority's intervention operations, specifically whether the HKMA is defending the Hong Kong dollar peg through US dollar sales from its exchange fund, through emergency borrowing from the Federal Reserve swap line. Peg defense through exchange fund dollar sales is a normal operational response to Hong Kong dollar weakness. Emergency swap line borrowing signals that the exchange fund's dollar reserves are insufficient to defend the peg at the current intensity of demand, a signal of peg vulnerability that would generate self-reinforcing speculative pressure against the peg and dramatically amplify the dollar demand that is already generating the 13% overnight rate. Fourth, watch the cross-currency basis swap level for the euro-dollar pair specifically. The euro-dollar basis swap is the deepest and most liquid cross-currency swap market in the world, the market that the largest and most sophisticated financial institutions use to manage their dollar funding. If the euro-dollar basis swap deteriorates below negative 150 basis points, indicating a dollar procurement premium exceeding 1.5% above the risk-free rate, it signals that the press has reached the core of the global dollar funding system, rather than remaining in the periphery where Hong Kong and emerging market dollar stress typically originates. Fifth, and most critically, watch for any statement from the Federal Reserve outside of its normal communication schedule. An emergency statement from the Federal Reserve Chair or the New York Fed President outside of scheduled FOMC meetings or press conferences is the most unambiguous signal available that the Fed internal assessment has concluded that the funding stress requires immediate policy communication to prevent the confidence deterioration that amplifies funding crises beyond the liquidity stress that generates them. Emergency Fed communication has preceded every major emergency intervention since 2008 by hours to days. It is the earliest available public signal that the institutions with the best information have concluded that the situation is beyond the management capacity of normal market mechanisms. Here is the final truth that dollar swap rates at 8% and Hong Kong overnight funding costs at 13%, with funds trapped demand be stated, with the operational urgency that these numbers represent. The global financial system runs on dollars, not metaphorically. Operationally, the settlement of the vast majority of global trade, the management of the vast majority of global financial contracts, and the operational functioning of the vast majority of the world's financial institutions all require access to dollars at prices that their business models can absorb. When the price of operational dollar access reaches 8% to 13%, the global financial system is not experiencing stress. It is experiencing the specific, acute, systemically dangerous condition where its operational fuel has become too expensive for the machines it powers to continue running at normal capacity. The machines do not stop immediately, they run hotter. They consume more energy per unit of output. They generate more friction. And if the fuel price is not reduced to operational levels quickly enough, they begin failing. Not from a single catastrophic breakdown, but from the accumulated stress of running at emergency intensity for longer than their design parameters anticipated. The dollar funding crisis is not a story about finance. It is a story about the operational infrastructure of civilization, about the hidden plumbing that makes the global economy function and that most people never think about until the pressure in the pipes reaches 13% and the funds are trapped, and the machines that the plumbing powers start running hotter than they were built to run. The Federal Reserve knows this. The institutions generating the 8% swap rates know this. The hedge funds trapped at 13% Hong Kong costs know this. The question is whether you know it, and whether you know it before the machines start failing.